Welcome! Today we'll learn about the four variance analysis for plant controllers. This is an important tool in cost accounting that helps us understand different types of variances. Let's break down the four main types of variances we'll be analyzing. First, we have the spending variance, which measures the difference between actual and budgeted costs. Second is the efficiency variance, showing how efficiently resources were used compared to standards. Third, we have the production volume variance, measuring differences between expected and actual production. And finally, the flexible budget variance, which compares flexible and allocated budgets. Let's look at how these variances apply to both variable and fixed overhead. Here's our analysis framework. For variable overhead, the spending variance is calculated as the difference between actual variable overhead and the actual input quantity times budgeted rate. This can be written as actual variable OH minus actual input times budgeted rate. For fixed overhead, the spending variance is simpler. It's just the difference between actual and budgeted fixed overhead. The formula is actual fixed OH minus budgeted fixed OH. The efficiency variance measures how well resources were used. For variable overhead, it's calculated as the difference between actual and budgeted input quantities, multiplied by the budgeted rate. Production volume variance only applies to fixed overhead. It's calculated as the difference between actual and budgeted output, multiplied by the budgeted fixed overhead rate. Finally, let's look at how all these variances connect. The total variance is the sum of all applicable variances for each overhead type. Remember, for variable overhead, we focus on spending and efficiency variances, while fixed overhead includes spending and production volume variances. Understanding these relationships helps us better analyze and control costs in our plant operations.